This session will aim to give advisors a greater understanding of investing in direct equities by reviewing the following questions. What are the basic fundamental principles of stock picking? Is stock picking more art or science? Does stock picking add value? How can you balance risk and reward? How much diversification should there be? And how should a UK equity portfolio be structured? During this session, we'll hear from Guy Stevens, Managing Director of Rowan Dartington Signature. Guy joined Rowan Dartington in September 2011. He's an associate member of the UK CFA Society and the Chartered Securities Institute. He joined the City of London in 1990 as an investment analyst, following a mathematics degree, becoming a UK equity fund manager for Refuge Assurance, now part of Royal London Asset Management. He joined Clark Wilmot Solicitors as investment manager in Taunton in 1998 and has provided investment and portfolio management advice to private clients and intermediaries ever since. In 2001, he joined Rowan & Co. Capital Management in Bath as investment director, becoming the group investment director of Ashcourt Rowan, following a merger. He was responsible for the design and implementation of the investment process, strategic asset allocation policy, and the performance and management of £1.2 billion of funds under management. By the end of this session, we hope that advisors will be in a position to understand the stock picking process of a fund manager, develop a reasoned view on the passive and active management, assess whether a DFM is managing equities effectively, and recognise a well-structured portfolio at a glance.
There are 6 basic fundamentals of stock picking: research material, relevant investment themes, financial analysis, growth potential, valuation, and risk. Research material cannot be underestimated. It's very important to get as much research material as you can when analysing a particular investment. Usually this should come from external sources, and you should be aware who the originator is. The house broker of the stock concerned will always have a buy recommendation on the security. They will also usually have the best access to information about that particular company. So it's a very good source of the most accurate information, but the final recommendation will almost always be a buy. So it's very useful to have a buy recommendation and perhaps a sell recommendation, and maybe a hold one as well. Then you get a balanced view of that particular investment. Secondly, relevant investment themes. That will drive your idea flow. So for example, at the moment and quite recently, fracking has been a particular keen investment theme because of the potential growth in that area, and certainly businesses involved with the picks and shovels of that industry. House building recently, because of the changes and initiatives by the government for the funding for lending schemes. That has been a very successful theme over the last 6 months and perhaps a little bit longer. And of course, we're all aware that you get themes come and go, technology, all sorts of particular areas which drive certain areas of the stock market. So it's quite important to have a reasonable set of ideas, keep very aware of macro influences in the economy, and that will naturally lead through to relevant investment themes. When you've decided the areas that you're interested in, financial analysis is then absolutely key. One of the most absolutely vital parts of financial analysis is cash flow. And we're going to look at a slide here for a business called James Fisher. Now, James Fisher and Sons produce mining equipment and are involved in the oil industry. And on the cash flow slide that you can see now, the business has been doing very well recently. And this particular cash flow statement is very clear and illustrative. Not all businesses are this clear or comprehensive with the amount of information they deliver to the market. So the fact that they are that transparent is a big tick to start with. If you look down the statement, there's obviously a lot of technical detail on this. You can see the underlying operating profit there on the top has grown quite respectably. if you work then further down, 2 lines, working capital. That's the amount of capital and cash that's actually tied up in the business. Now you can see over this last year that's improved dramatically from a negative of 10 million to a positive of 0.5. That's absolutely fantastic turnaround in the working capital in the business. If you then look one step below that, pension contributions, you can see there's quite a big negative there, 4.2, 4.8. That gives a clue that there could actually be a pension deficit problem with this company, and in fact there is. So that's showing that there's a drain on the cash reserves of the company on an ongoing basis. Now it's not particularly large in the overall scheme of the profitability of the company, and so it's not necessarily a big negative, but it is certainly something to be aware of. And you may be aware that there's some big companies in the stock market. British Telecom is one, for example. We'll come on to it later, but Royal Mail has been another where their pension deficit has been quite a major negative for the stock. And this is why it hits the cash flow of the company. If you scroll down a little bit further, you'll see the jump in the operating cash, and that is all to do with the cash conversion rate, which you can see at the right-hand side there, 132%. A normal typical figure of cash conversion there would be between 80 and 100%. So you can see there at 132%, that's a very strong result. Looking a little bit further down, net capital expenditure, you can see that that's risen from 17.1 to 26.2 million. So this company's been investing in their services, research and development, etc. And so that's a drain on their cash. But because of their conversion rate, you can see that actually the company can easily afford that. And so if we drop all the way down to the bottom, you can see the net debt carried forward figure has jumped from a negative 98.8 to a negative 63.1. So that shows that this business has got very strong cash generation. And that's a key positive for any business. Businesses that run out of cash go bust. Not rocket science, of course. If we look at the top right there, we've got this acronym EBITDA, and that's earnings before interest, tax, depreciation, and amortization. And what that does is it strips out all of the various random items that could influence profitability. And that is effectively the cash flow of the business. And again, you can see how that figure has improved. And then the next line down is net debt to EBITDA. So that's basically borrowings to cash. And it's fallen from 2.1 to 1.2. Now that number should normally be below a figure of about 3. Anything above that, then the balance sheet of the business is starting to become constrained. So clearly down at 1.2, this is a business that has a very strong balance sheet, very strong cash flow, and therefore is in a very good position to expand and invest going forward, despite having some negatives such as pension contributions. So that's why we've selected that one. They don't always look as good as this one. Moving on to growth potential. Obviously, what's fundamental when stock picking is you buy a business in terms of the shares, what is the potential for the growth of earnings? And so if it's a utility company, we all know that those are defensive businesses, they're often invested in for yield, they're not going to particularly grow their earnings. Whereas if you invest in mid caps and small caps, you're going to find there's much more potential for growth going forward in the business model. Absolutely key if you're investing for that type of business in a growth type of mandate for a client. Obviously, if it's an income mandate, you're not going to be pursuing the growth to such a great degree, but you will be still interested in dividend growth. And of course, that rolls back to cash flow, working capital, and everything that we've just touched on. And of course, the relevant investment theme also picks into there. Valuation. The most commonly used valuation metric when analysing shares is the price-earnings ratio, which I'm sure most of you will be familiar with. Earnings per share divided into the share price to give a figure. The average of the stock market is normally around 15 times. So if a stock has high growth potential, stock like James Fisher, for example, you would expect it to be trading on a premium price-earnings ratio to the market. Similarly, if it's a business that's on poor times, struggling, you would expect it to trade at a discount to the price-earnings ratio. A lot of commentators say, oh, well, you just buy low PE shares and you steer clear of high PE shares. Unfortunately, it's not as simple as that because businesses can be growing at quite a high rate, have a high PE, but they continue on growing and continue with their share price appreciation. So clearly you don't want to naturally miss out on that potential. So you have to analyse the level of the price-earnings ratio relative to the market and take into account the growth potential of the earnings. There is another ratio out there called the price-earnings to growth ratio, or PEG ratio, which I won't touch on in detail, but that is a good measure of assessing whether the high price of a share is actually worth paying for. Similarly, when it's a discounted PE, if the share is trading on 6 times PE, you may think, wow, fantastic value. The problem there is invariably a stock that's trading on a 6 times PE will have problems. And of course, you have to analyse those problems and take a view as to whether you believe the market is over-discounting those problems into the market. And of course, that's what then happens when there's a shock. You may have bought the shares, there's a big surprise, and off the thing goes, and you make lots of money for your clients. Of course, that's the golden scenario. Finally, risk. Risk is obviously inherent in all shares. All stocks have risk, which is higher than fixed interest and other alternative asset classes such as property and, of course, cash. Now, that risk will vary. One of the most popular risk measurements that we'll get onto a bit later is volatility, and that's the amount by which the share price goes up and down on a daily basis. Now, this can be illustrated quite easily in the FTSE 100. When the stock market is up, say 100 points, the top risers of the top 10 will invariably be a reasonable number of mining shares. Mining shares are highly volatile. They tend to be in fairly questionable jurisdictions politically. There's a lot of administrative risk in terms of extraction of the asset out of the ground and getting it out of the country. And it can lead to all sorts of disruptions, strikes and problems. So mining shares are some of the more volatile members of the FTSE 100, and similarly when the stock market is down, they will usually be those towards the bottom of the performers at the same time, whereas of course stocks like Tesco or Sainsbury's, food retailers generally are much lower risk because they're much more of a consumer staple. Is stock picking more art or science? This is a subject of huge debate. Quantitative factors are usually science. So in the previous section where we were talking about price-earnings ratios, valuations, cash flow analysis, this is all analysis of quantities, i.e. numbers, and that's the scientific part to the analysis. Qualitative factors are the art, and that's where you introduce subjective overlay to whatever the numbers delivers. So for example, one sector at the moment that is particularly in favour is house building because of the government initiatives. The only thing is these stocks do have a higher level of risk because if we all think back to the late 80s, a lot of house builders went bust when the housing market collapsed. And that's because they have a lot of working capital in terms of building out properties. And it depends on the length of their land bank. So different businesses have different aspects to them which can come through perhaps once every 10-15 years, which will not be revealed in the science. And so this is where the subjective decision making has to sit over the top of it. If we look at a slide for the current issue for the Royal Mail, this will illustrate this in more detail. Most stocks, when you're actually analysing them, will come out with 3 reasons why you should buy the stock, and usually 3 to 4 why you shouldn't buy the stock. And once you've analysed that and you've deduced what the key pluses and minuses are for any investment decision, you then obviously need to take your view. So if we look at that slide, the reasons to buy, the first one in there would be the significant potential to increase operational efficiency. We're all familiar with the impending strike. Now that gives a suggestion, a positive suggestion, that actually there's a huge amount of inefficiency within the Royal Mail. And this was similar with British Telecom when it floated years ago. And as a result, it was typical of a nationalised industry and there was quite a significant amount of efficiency that could be introduced to the business. Now, you'll see the top one of the reasons not to buy is the same. Of course, if the business suffers from a strike, which will cost it money just at the time when it's floating as well, this will also be a short-term negative to the business. So the reason not to buy is probably short-term, and the reason to buy is probably longer-term, depending on how long you're planning to own the shares for. Another reason to buy the Royal Mail is actually there's fairly limited regulatory oversight from Ofcom. Previous new issues, such as British Telecom, have had huge monopolistic advantage, and so therefore the regulator has to put in pricing controls. For the Royal Mail, this hasn't been the case, and in fact only about 5% of their business is subject to price control. And so really, when it comes to the two parts of their business, which are letters and parcels, really the competitive forces that are affecting the Royal Mail are fairly open, and therefore the Royal Mail is open to set its own pricing without abusing the population. That's the thinking. Time will tell. And the third reason to buy, this is a typical example of an art subjective influence, is the political desire for the issue to be successful. You can't put any number on that or anything quantitative. Clearly, the Treasury will be saying, and Her Majesty's government, we really do want to make sure this is a success. We want to leave some value on the table. If we can get a 5% premium on the price on day one, that will be a big tick, because this is a forerunner to when TSB hives off from Lloyd's, and also when we want to start reprivatising Lloyd's shares. So there really is a huge political will here to make the Royal Mail a success. And that's an attraction to the shareholder, because previous privatisation under Margaret Thatcher's era, privatisations were almost a gift, and everybody went for them big time because it was almost a given that they were going to be successful and that you were going to make money. The other reason to buy the shares is it's going to have a very attractive yield to it, in excess of 5%. Now, some would argue it has to have, because it's not exactly the most exciting business. And so in this era of low interest rates, where a lot of investors are struggling to get enough income from fixed interest and from cash, clearly buying something like the Royal Mail, which gives an attractive yield, could be quite attractive. If it didn't yield that figure, then it may struggle to get away. Going down for the reasons not to buy, we've done the first one. The second one, it is a highly cyclical business. It only earns margins of 5%. And what this will mean is that when the economy goes into recession and businesses are not sending parcels, retail spending goes down, and a lot of their parcel deliveries in the future should be linked to internet shopping, this part of their business is going to struggle. And so therefore you would naturally expect it to be a lower PE share, as talked about before, because it's not going to be massively growing its earnings going forward. When I talk about low margins, as I say, 5% is a pretty low margin business. Parcel growth is what it's all about, because letters are gradually declining with social media, and it's a highly competitive marketplace in terms of parcels. If you actually order online yourself from Amazon and all the various online retailers, how many times does Parcel Force deliver to your door? It's invariably it's some of their competitors, whether it be Lynx, UPS and all the others. And so this is highly competitive, and this really is the future for the Royal Mail. Now clearly it's a big negative if they can't compete on pricing, and if quite a lot of their staff are on strike. So this is a share offer. Has positives, has negatives, and obviously you pay some money, it takes your choice. So that's basically the example that I've used to illustrate how you have art, you have science, and then there's also a huge dose of subjective opinion that has to sit over the top of it. Does stock picking add value? There's a huge debate in the industry which has been going on for many years and will probably continue for many years about whether passive investment really is the way forward or whether active really can add value. I personally have mixed views. Sometimes passive works very well if you are investing in very efficient markets. whereas active is really best served to inefficient markets, which means you can find value. The best way to illustrate what you're actually doing if you invest on a passive mandate and the decision that you are actually taking there to turn your back on all the supposed talent within the industry is to look at the next chart. Now what we've got here is a pie chart, and what this shows is the structure of the FTSE All-Share Index. And so what you have is 84.2% of the all-share is FTSE 100, 13.5% is the next 250 shares, and just 2.3% is in the small cap. Now you may recall earlier that most of the opportunities that are inefficient in terms of market valuation, where you can actually pick shares like James Fisher, which make value, are held within the FTSE 250 and the small cap. Now if you buy a passive investment, or say a FTSE all-share tracker, what you will actually end up with in terms of your investment exposure is 84.2% in the FTSE 100. And in fact, of that, as you can see where I've extracted the top 5 there, 23.8% will be in the top 5 biggest stocks in the market. So you will be investing 6.7% into HSBC. Now, when you consider that some of the best opportunities are in the small cap, which is 2.3%, what would you rather be doing? Would you rather have, if you actually took the top 3 and added them together, that would actually be roughly equivalent to the entire FTSE 250 and small cap added together. So you have that choice. If you buy passive, then you will end up with HSBC, BP and Shell, or you could take that same percentage allocation and you could have FTSE 250 or small cap. Now, in terms of our experience, in terms of our skill set, we would tend to suggest that the best approach is to make sure you have reasonable exposure to FTSE 100 shares, but you also need to have plenty of other types of exposure where you can add value and the rest of the opportunities can be found within the market. Careful fundamental analysis can add value, as we indicated before, but it can't really add value within the FTSE 100. The problem with the FTSE 100 is it is so well analysed and covered by the city. The share prices are incredibly efficient, and when shocks hit the market, for example, recently there was a significant move in the shares of Vodafone, which caught the city by surprise. That just illustrates how efficient market hypothesis doesn't really apply in cases like that, because otherwise the share price couldn't move that much. And there's no way you could have predicted that through your analysis. It was an announcement that came out and caused significant move in the share price. So conviction and patience is another area which has to win through in time. If you've analysed the company and you've done your fundamental analysis and you feel comfortable with the business model, you like the cash flow, has a strong balance sheet, then yes, the share price will go up and down over time with the vagaries of the market, a lot of it external factors, things affecting the investment theme that the stock is actually involved in. But if fundamentally that business has competitive advantage, has good management, has a good cash flow, a very solid revenue, well-diversified revenue stream, and it also has a growing dividend, then your conviction and patience should win through over time. It's very, very important to avoid speculation and fads. Speculation is always here in the market. At the end of the day, a share price is the coalescence of all the views in the market, whether they be science or whether they be art, whether they be speculation or fad, conviction or patience. And all of these has different influences at different times. It's very difficult to spot when we are in a speculative bubble, and these days, unfortunately, everybody seems to cry bubble the moment something goes up 5–10%. That's because we've recently come through the biggest bubble that most of us have seen in a generation. Now that in itself provides opportunity. Plenty of people have been calling this from the housing market moves that we've seen, that we're already in a bubble. Yes, maybe in London, but that's not due to the government initiatives. That's due to external investment flows coming into the country. If you go out into the shires and the regions, you'll find that it's a very different story. fads, I mean, we all know about them. Remember the technology boom. These will always come and go. What's most important is if you are fortunate to be holding a share that does actually benefit from a significant move and seems to be in the right place at the right time, is never forget that there's a huge amount of luck involved in investment. And so, especially if you're adopting an active strategy, never ever get convinced of your own abilities and think you're the next Warren Buffett just because you happen to hold a share that goes up 25%. This is particularly the case when you go down into the mids and small caps. Lots of volatility, lots of extra risk, share prices move around, and it's very important not to get sentimentally attached to a share. How can you balance risk and reward? The first statement I would say on this is avoid disasters, because if you can do that, it will deliver outperformance. Now that sounds like a very obvious thing to say, but really what I'm really saying on that is if your focus in terms of finding investment opportunity is purely on the upside and what may go fantastically right, and you tend to ignore what could go wrong. In other words, if you take a very optimistic outlook on stock picking rather than a pessimistic one, you are bound to come to grief. You will always be pursuing what seem like fantastic money-making opportunities in the marketplace, and unfortunately it's not as easy as that. If you actually avoid some of the disasters, and some of these are quite easy to spot. So for example, in the FTSE 100, there's been quite a few questionable flotations from overseas mining companies, which only really came to the UK stock market because of the relatively relaxed listing rules. Those sort of stocks, which have very concentrated shareholder lists from overseas oligarchs and some questionable jurisdictions, are best avoided. Now, if you can do that and you stick to quality, then of course you outperform the FTSE. It's not particularly rocket science. And so when investing in the FTSE 100, outside of mid 250 and smalls, that is almost like a golden rule, is don't try to be too clever, don't get too involved in the upside, because you may actually ignore the downside. And that comes back to the previous section. There are always 2 or 3 reasons to get excited about an investment, but don't ignore the 2 or 3 reasons to get quite concerned about the investment. And you have to weigh up the pros and cons. Not get too bearish, but not get too bullish as well to balance it all out. If you get too bearish, you'll never do anything. And if you get too bullish, you're going to lose your shirt. So it's you've got to match the 2 together. The next part of this is a little bit technical, but it's quite important. But I don't think it's something that should be ignored. We've touched on volatility earlier, and if I refer to the next slide that we've got here, what I've got here are 2 stocks, Centrica and Rio Tinto. Now, as I mentioned earlier, a utility stock like Centrica has a relatively low volatility number, and by volatility I mean the amount it goes up and down relative to the market. So you can see there I've got the FTSE 100 volatility figure of 15.08, and Centrica is slightly higher than that. Now the reason it's slightly higher is because it's an individual stock, whereas the FTSE 100 is of course 100 stocks. So it would have by nature lower volatility because there's all the different stocks to cancel each other out. But that said, Centrica is still one of the lowest volatility stocks in the FTSE 100. If we then look at Rio Tinto, you can see the figure there is 33. And that illustrates what I was saying before. When the stock market is strong, mining stocks will be probably in the top 10, and when the stock market's weak, the opposite will apply. And so when you're building a portfolio, it's very important that you understand all of those interacting volatilities and how they will all move together. Because clearly if you have too many Rio Tintos in there, when the stock market's going great, fantastic, but when the music stops, it's all going to look very sick indeed. And then you have very angry clients on the end of the phone. So it's very important. But then again, if you put everything into Centrica, you're not going to make a lot of money. So it's a real mixture. Now the Sortino ratio may be something that's new information to you. Most of you will probably have heard the Sharpe ratio. Now what the Sharpe ratio used to measure, what still does, was the risk-reward offset. So basically, if you buy a higher volatility share, what sort of reward are you getting for taking on that extra risk? And is it worth it? Because there's no point in taking on extra risk if you don't get the return. The Sortino ratio, what that does, it's almost like half the Sharpe ratio. All it does is it measures the downside risk. And so, for example, what that's saying is when the stock market is really weak, how weak does this particular share perform? So as you can see, the FTSE 100 benchmark Sortino is 0.44, Centrica is 0.56. Now, because it's a higher figure, what that means is when the stock market falls, Centrica will hold up more than the stock market. Now, that's obviously good news for defensive type of mandates for clients. Centrica is an income stock to a degree, and so that's the sort of characteristics you would want if you were building a low, medium, or a cautious type profile. Rio Tinto's figure, as you can see, is minus 0.16, and what that means is, which we all know, is when the stock market goes through a difficult period, it's really going to hurt in Rio Tinto and all the other mining stocks. And so when you build a portfolio, what's important to look at the whole piece together. What is the volatility of my portfolio relative to the market? What is my Sortino ratio relative to the market? And therefore, if you have a mandate which is higher risk and growth, you would expect it to be more volatile and have a higher Sortino ratio than the market. Now, the ideal there would be you get more risk, more volatility, excess return, but it actually is relatively defensive when the market cracks. And that's really the ideal. Now, that obviously doesn't always happen, as we will well know. And so that's the volatility and the Sortino ratio explained. How much portfolio diversification should there be? And by that I mean, if you're investing in direct equities, how many shares should you have? Now, most of you will be familiar with the unit trust industry, OIK industry, where a concentrated fund would be one that perhaps only had 35 to 40 holdings. Now, when you're investing in a private client portfolio, you wouldn't normally have that many because you would also have lots of other investments, overseas funds, other asset classes, etc., to further diversify the portfolio. Now, in fact, in terms of statistical evidence to this, I've got a slide to demonstrate this, which is actually showing that there is very limited benefit beyond about 20 stocks. And what this shows is the expected standard deviation of annual portfolio returns, a bit of a mouthful. And so, as you can see, when you increase the number of stocks down to 20, you have this expected deviation of 21, and then it drops very, very slowly from there on. Even so, where you have 1,000, that the figures only drop down to 19. So what you can see there is that really the diversification benefits beyond about 20 to 25 stocks. You've really diversified as much of the direct equity risk that you need to when you get to that level. And so really beyond that, it comes down to opportunities. If you over-diversify, then you are effectively becoming a passive tracking type of investor. And we're all familiar with quite a lot of skepticism in the industry where so-called active UK funds have 70 to 80 stocks, and in terms of their performance return, you're paying an active fee for potentially passive delivery of results. Now, clearly that's not the right answer, but this is why it happens. You've got to have conviction, and you cannot actually introduce conviction into a portfolio if you have too many stocks and too many positions, because everything just cancels out. When you are building your portfolio and you've got your 20 to 25 stocks, what's really important is you need to be aware of all of the interacting correlations of all the different constituents in terms of overseas domestic earnings bias, growth and income bias, defensive cyclical bias, the sector dynamics, and the liquidity of the holdings that you've actually got, because there's no point in you having a wonderful idea in there if you can't actually sell it when it's time to take the profits. So building all of those together is very important. you may be familiar with the fact that the FTSE 100 is actually a very internationally diversified index, and about 75% of the earnings of the FTSE 100 are actually from overseas businesses or overseas earnings of a UK business. And so when you buy a FTSE tracker and you're doing your asset allocation and you think, well, I'll take UK exposure by that route, you're actually only buying 25% of the UK economy. When you go down into the mid-caps, you get far more focus on domestics, and you introduce a lot more influence from the UK economy. And so because of that, when you're looking at your defensive cyclical biases, as you go down the market cap area of the market, you are becoming more dependent on the vagaries of the UK economy. That said, there are plenty of exporting, manufacturing and industrial businesses in that area of the market. And of course, that's when sterling comes into play. And of course, it's very important what is going on in the overseas markets. So for example, quite a lot of the stocks that we cover have been influenced, well, positively and negatively, by the fiscal cliff, when that was a very important feature in the markets at the beginning of this year, because that all led through to government contracts for defence contracts, and a lot of these businesses are involved in that area. Similarly, with the China slowdown, quite a number of the businesses in the UK are highly dependent on demand from overseas, whether it be tobacco or whether it actually be manufacturing. And so what's going on in terms of emerging markets in China is also very important. So just buying a FTSE tracker or the UK market as a block, you're not actually buying what you may think you're buying. And this is why we prefer certainly to analyse the underlying companies, because then you actually know what you're buying. You understand the vagaries and the positives and the negatives, the risks and the rewards. And when something happens out in the marketplace, you have a much better handle on how you're exposed to that. And if you have too much diversification, then all of that area of potential value added gets completely diluted away. So the key with diversification is, yes, you need it to soften against the shocks, but you don't want too much, because otherwise you're just delivering a tracker. And that isn't really what we believe in. Active management can add value over time. How should a UK equity portfolio be structured? Well, bearing in mind what we've said in the previous section, it won't surprise you that really it should have no more than 25 to 30 holdings. You shouldn't have fewer than 25, because then you really are getting into too much stock-specific risk. But anything more than 30 and you really are starting to dilute the opportunities away. First and foremost is you need to be sector aware. There are 5 big main sectors in the all-share market. That's the whole stock market. Oil and gas, we saw from the earlier slide, BP and Shell, they're big entities there. Mining is a significant portion of the market. Some of it you wouldn't want to own, but you do have some good quality businesses there. Pharmaceuticals, quite focused actually. There aren't a huge amount to choose from, and dominated by Glaxo and AstraZeneca. Then you've got telecoms, the mighty Vodafone and BT in there. And then finally you've got the banks, and we all know, love and hate those. And so what's really important is that you have a decent exposure to those big 5 sectors as a building block, because they do tend to move as a block. And so obviously very recently banks have all been under a cosh, and over the last year they've all actually recovered quite nicely. So you can take a sector view in those big 5 sectors as a good starting point as to where you want to be. And you will get an investment theme and a subjective opinion that overrides that view, in addition to the fundamental analysis. So when you've got those constituents in your portfolio, you should then be making room for the satellite. So you have a sort of core satellite blended approach. And that's where you really get into the more creative idea generation, where you slot in ideas which are outside those bigger sectors, which are a combination of your best thoughts going forward. And I mentioned fracking earlier. There's a number of businesses in the market that are actually nicely exposed to the potential in that industry. But you've got to make sure that you climb aboard those themes at the right time and aren't at the back end of the queue when it's all been priced into the market. So you have to be very careful on how you structure that. You need to ensure there's a diversification of earnings. That's really important because when the economy goes through a growth pause or a particular feature comes from left field, like we had David Miliband recently talking about putting pricing cap on utility prices, that led to a 5% fall in Centrica, for example. So you don't want to have too much exposure to any one particular sector because you've got to absorb those knocks. And so in the last week, if you'd have had Centrica, but you'd also have had Persimmon in there, which has gone the opposite way because the government's brought forward the housing support schemes, then the two would offset one another. And obviously it would be great if you had it all in the right place and not in the wrong place, but unfortunately the world isn't like that. Growth and income is very important, so if you have a growth mandate for the particular portfolio, then obviously there would be more of a concentration in that area, and that will influence the sector exposure. And then the same goes for income, of course, whereas more focus you've got in that area would tend to indicate a lower risk type of portfolio. Income shares generally a lower volatility, higher yield, of course. Growth tend to be more volatile, lower yield, but more earnings potential. And finally, if we refer to the slide that I've accompanied with this, we have a sample portfolio here, which is a typical medium balanced model portfolio. It's purely equities. You'll see if you look down there, in terms of the number of stocks, it fits with what I previously said, 25 to 30. You can see the yield. It's a very sort of middle of the road yield, not particularly high yield, but similarly not particularly low because it is balanced. It's a combination of growth and income. You can see, looking down at all of the sectors, very broad exposure there between oil and gas, 4 constituents there. 2 big ones, obviously BG, Royal Dutch, and then 2 that aren't quite so large. And so it goes down, 2 mining constituents there, Billiton and Rios. In the industrials, those are very more stock specific. Consumer goods, again, large companies. There's the pharmaceuticals there with a decent representation, etc., all the way down. And so you can also see what the market weight is to those sectors, and you can see what our sector bias is in terms of being underweight or overweight. And that's where the top-down influence comes as to whether we want to be overweight to the oil industry, what's our view on the oil price, all the rest of the influences that can possibly affect the dynamics of a major oil company. And then right down the bottom corner, there you've got the portfolio volatility and the Sortino. And in brackets, we've got the figures for the market. Those are for the all share that I've put in there. So you can see that the volatility of this particular portfolio is less than for the market, being on 15 and the portfolio on 11. And the Sortino is actually greater. So what this is saying is that because this is a balanced portfolio, it's got defensive attributes, it's got some growth in there, but on the whole, it is very medium balanced type of profile. It will actually be less volatile than the stock market, and should things take a turn for the worst in the markets, it will actually hold up rather better. Now, obviously, what you also want is for the whole portfolio to outperform as well, and that, at the end of the day, comes through your fundamental stock picking analysis. Now, the one thing that is quite important here is that the analysis is absolutely key, and there has been quite a lot of fads that have come and gone to do with black box type of investing. Some fund managers were particularly successful at this in the past. Lion Trust was one with its first income product. Artemis European was another one which you may be familiar with. And the thing that you'll notice is these things come and go. And what often happens is that the hedge fund industry and competitors learn how to replicate the process. And so whatever advantage had been identified by that black box approach has been competed away. And really, in terms of stock picking, there is no shortcut to it. It comes down to fundamental analysis, comes down to experience. It comes down to having a very, very clear head on what you're actually investing in, and not getting caught up with the speculation and noise that often comes through into the market from all angles. And keeping a cool head at all times is absolutely vital.
We hope that you've found this session useful and are now in a position to understand the stock picking process of a fund manager, develop a reasoned view on the passive and active management, assess whether a DFM is managing equities effectively, and recognise a well-structured portfolio at a glance.